Hello everyone, welcome to today's Luohan Webinar. It's Shang-jin from Luohan Academy. So today we are very happy to have Professor Shang-jin Wei from Columbia University to talk about FinTech as a financial liberator. So Professor Wei is the NT1 Professor of Chinese Business and Economy, and also the Professor of Finance and Economics at Columbia University. And he's a noted scholar on international finance, trade, and Chinese economy. He has received numerous prizes, including 2019 Contemporary Economics Prize, the Sun Yifang Prize for Distinguished Contributions to Economics, Zhang Peigang Prize for the contributions to the economics of development, and Pushan Prize for the excellence in research on the world economy, and Anthony Kai Prize, a research prize on international trade, and the Gregory Cho Award for best research paper. So without further ado, Professor Wei, the floor is yours. Please take it over, and you will have about 90 minutes. Please go on.
Thank you very much. Good morning, good afternoon, good evening, everyone. So this is a joint venture with Greg Butchek of Stanford, Jiaying Hu of Peking University. So the word financial liberator is a reference to the idea of about ending financial repression. So let me go to this slide. Financial repression refers to essentially paying households a very low interest rate below freely determined level, below market interest rate. And that phenomenon of financial repression is very common in developing countries. The term was first invented by McKinnon and Shaw back in the 1970s. But subsequent literature, including Rubini and Salahi Martin, documented that it's not only it's widespread, but it's very sizable type of a distortion in some developed countries in early days, but certainly in most developing countries. And this phenomenon, financial repression, is a source of distortion. It affects allocative efficiency and potentially affects fairness and so on. China had, our sample country is going to be China, and China had financial repression of this type all the way until 2013. Financial repression is a form of implicit tax on household savings, but it is a benefit. It generates benefits to banks. So we have to keep that in mind. It doesn't, I mean, someone benefits at the expense of other people.
Professor Wei, can I ask maybe one clarifying question?
Yeah, people should feel free to interrupt me until we're about to run out of time, then we're going to decentralize. Yeah. So go ahead, please.
Actually, in the developing countries, so how do we really know the market interest rate?
Yeah, so variety of research trying to do that. So like in the case of China, I'm going to show you a picture about the best guess of a market interest rate as well. So I'm going to come to that. But for other countries, a bunch of empirical studies can look at the actual interest rates paid by financial institutions and likely market determined interest rates. The research question today is a role of FinTech in removing or ending financial repression of this kind. By the way, if you have questions in the chat room, I won't be able to see it, so feel free to unmute yourself and ask me questions. Or you can let the moderator know. He can help me with questions. So here's a picture that summarizes some of the basic information. On this picture, I have to move the bar so I can see the slides myself. On this picture, I essentially plot the various kind of interest rates from 2003 to more recent years. The solid black line at the bottom is the maximum interest rate banks were allowed to pay on household demand deposits. So it's extremely low. The fluctuating broken blue line is essentially a proxy for market determined interest rate. More precisely, this is the 3-month SHIBOR rate. And this picture tells us a few things, but three are especially worth highlighting. One is interest rate households that you receive on their deposits were way below market interest rate. Number one. Number two, the interest rate households received the ceiling on household deposit interest rates essentially were insensitive to supply-demand fluctuation in the market. And number three, the vertical broken line, this line marks June 2013. What's special about June 2013? This was a time when UBAR / Tianhong Jijin, Tianhong Money Market Fund, was introduced to Chinese households by Ant Group, Alipay. And the interest rate one can receive on Tianhong Jijin / UBAR were traced by this solid red line, which was essentially 3-month SHIBOR rate. So this is another way to say 3-month SHIBOR rate is a relevant rate. That once Tianhong Jijin facilitated the money market fund to China, make it available to Chinese households, that's the rate people receive. Okay, so and that's much higher than the interest rate the household otherwise receive on bank deposits. Okay, and the purpose of the paper and today's talk is to try to understand the role of a fintech enabled investment opportunity in ending financial repression. So we want to, this is exactly what I said. We want to study whether the fintech competition induced banks to raise returns on household savings in response to fintech competition. And we find the answer is yes. And in that sense, fintech is a financial liberator. More concretely, we study how the combination of a paytech, Alipay in our example, and money market fund creates a close substitute for bank deposits, forcing banks to respond. Whereas previously, the bank interest rate were kept by regulation, and banks didn't really have much incentive to lobby to remove the regulation because banks collectively benefited from artificially low interest rate, and the regulatory ceiling acted like a coordination device. That you don't need to worry about other banks outbid you by paying more to their household deposits.
Hi, Professor Wei. Excuse me.
Please.
Yeah. So my wonder is that so you show the evidence that UBAR, okay, plays a role of elevating the financial repression just now. But my question is that its role is through money market funds. So this function does not depend solely on fintech. So it also exists when people go to banks. So
we're going to show you evidence that's not the case. Okay. We're going to show you evidence that, in fact, so maybe the next slide will be I'm going to show you that. Essentially, in words, money market fund products, why they existed, they were essentially invisible to most Chinese households. No banks were offering money market fund products to customers at the time. If you are still able to remember the time before 2013, and money market fund generally, in fact, mutual fund industry generally was extremely small then compared to it is today. It's not like today. Today it's still not as big as banks, but they are much bigger. Prior to June 2013, the entire mutual fund industry was small, and money market fund was small, and they were small endogenously because households were not familiar with them. Households didn't want to touch them. At least the data tells us that overwhelming majority of households had no investment in money market funds. Okay, so you mean I'm going to show you evidence. I'm going to show you in 2 slides. I'm going to show you a picture that make it very clear. But the summary. Let me summarize the data patterns I'm going to document in the subsequent talk. We're going to show that bank by bank, the demand deposits tend to, once UBAR was introduced, you're going to see a relative decline in the growth of bank deposits, and those banks that are more exposed to fintech competition tend to experience a greater relative decline in deposits. That's number one. Number two, we're also going to show you that the kind of things that Jianye mentioned, that nowadays people are familiar with various kind of so-called wealth management products offered by banks. Many of them pay market interest rate.
Maybe
what I'm going to show is that this was not available before fintech competition. They were the outcome. I'm going to document that they were the outcome of fintech competitions. Bank has to respond to competitive pressure from UBAR. The way to respond was to roll out their own products paying market interest rates. Okay, so in particular, we're going to document that in the initial period in which UBAR was introduced, different banks have different level of exposure to fintech competition. Those that had more exposure to the competition would have rolled out their market interest rate products a bit earlier. So the timing of rolling out market interest rate products by banks can be linked to differential competitive pressure from fintech products. Okay, and the third pattern I'm going to show is that so because fintech product puts pressure on banks, and banks have to defend their essentially capital base, not capital base, the deposit base funding sources by offering their own interest rate. And one of the possible concerns from regulator point of view is that banks' profit may erode, banks may engage in very, very risky lending behavior as part of their response. So we look into that, and we are going to document that there's no obvious evidence of banks engaging in more risky lending behavior in our data. So these are going to be the three major data. The paper has a literature review section, which I'm going to skip because of the time constraint. I want to just remind us about some institutional background. Some of you may not be familiar with this, some of at least not perhaps about some of the timings. So a few things that are worth highlighting. Number one, there's a very high concentration in Chinese banking industry. China has many banks. In our sample, we're going to work with many banks. 6 largest banks have a very high market shares in terms of deposits, lending, and number and bank branch counts. But our sample also going to work with medium and small-sized banks. Interest rate before 2013 was heavily regulated. Interest rate generally, both lending and deposit rates used to be heavily regulated. China has started a process of interest rate liberalization before UBAR was introduced, but the effort was focused on lending rates. The ceiling on deposit interest rate was not removed, apparently because it's politically much harder to do it. Banks didn't want it to happen. Regulators and banks are often the same kind of people. Banks are politically powerful. Senior bank officials can become regulators, and regulators can become senior bank officials. There's a revolving door between the two. So financial repression existed, and financial repression of that type was not that easy to be removed. It was the point I want to make. The second important background information is about the UBAR itself. Again, UBAR was introduced in June 2013. So remember, if you remember, I need to remember one date. That's the date, June 2013. 3 features about UBAR are especially worth mentioning here that make them to be a good substitute for bank demand deposits. One is it has unlimited so-called T+0 redemption feature that you can any money you put into UBAR, you can unwind and convert it back into cash instantaneously. There's no limit how many times you can do it, and there's no fee for that. Such feature did not exist for any other product bank offers, okay, except for demand deposit. A bank nominally before 2013 also had wealth management products, but they had a very high starting minimum investment amount. They did not allow T+0 redemption. Generally, there's a fee associated with redemption, and they were essentially irrelevant for most Chinese households at the time. UBAR offers T+0 unlimited fast redemption. UBAR offers market interest rate. UBAR has virtually no minimum investment requirement. Or 1 RMB is the official minimum requirement. 1 RMB essentially means no minimum investment. And UBAR, interestingly, also offers seamless use of redemption funds from Tianhong Fund for payment purchase purposes through Alipay. So that feature, in a way, could potentially make it even more convenient than bank deposits. So collectively, those features make UBAR a very good substitute for bank deposits, with again high interest rates and potentially more convenience if you're going to use it for offline or online payment. So here's a picture about history of the development of money market funds in the country. So again, the vertical line corresponds to June 2013, the time when UBAR was introduced. Before that line, so before 2013, money market fund collectively was tiny. Essentially, they were not relevant to most Chinese households compared to what we know about the what people, how many people buy money market fund today. After June 2013, there's been an explosion in growth. Here, maybe I have another picture. Okay, a separate picture will come later that shows that part of the explosion also comes from banks starting to offer their own money market fund products to households. Okay, we're going to work with 4 types of data. One is penetration of a UBAR, and the other is penetration.
Hey, Shang-jin, can I ask a question?
Please, Li.
Yeah. So this is sort of kind of a bigger picture question. So I understand when you introduce this kind of FinTech, that's kind of like a stimulator to liberalize the interest rate. But the government maybe introduced that regulation for some economic reason. I understand also you mentioned some political reasons like revolving doors. But getting around all this regulation, so what will be the negative welfare consequence? So can you sort of speculate that? It's not only about this as a bank versus this FinTech. It's, even you think about the small bank and the larger bank. So
okay, someone's writing on my slide. Anyone knows
I think it's probably he's using iPad. I used to have that experience too. Yeah. So if you think about the small banks,
Zoom stop price will be falling because people are able to write down speaker slides, I think. Sorry, Li.
Yeah. So some small banks also used to offer kind of repackage some products, like actually it's a 5-year deposit, and they repackage this looks like the 1-year deposit and offer to the market, and the interest rate can be as high as 5%, something like that. It used to be on Alipay and the Duxiaoman. Now they are all gone. So because of the regulators see this is some problem. So I just wondering, this is on the one way introducing FinTech allowed you to liberalize the interest rate, get around the regulation. But probably the regulator introduced this ceiling for some economic reasons. And maybe there's some financial stability or some kind of hidden cost we didn't consider. So now it only documented the fact that some potential benefit. So I'm wondering how to quantify that, how to think about this potential trade-off.
Yeah, that's a very important question. A financial repression is introduced in most countries, potentially including China, is a way to tax households. That a formal tax system may not be very efficient. There may be a way, there's massive evasion of a tax going on in the real economy in any country, including the US, but especially in developing countries. So tax slashing methodology is not very good. So essentially collecting tax on household savings is convenient for the government. But in this case, the tax collected did not go to treasury. Essentially, the subsidy to the banking sector. When you have when the banking sector is featuring politically powerful banks, banks benefit from interest regulation. Banks would not want the regulators to remove those. And it's not in the bank's interest to remove them. Let's say this way, and the regulators often listen to banks. Regulators often come from banking sector. Now, nonetheless, it is reasonable to wonder, could there be some negative side of financial liberalization or interest rate liberalization of that kind? In our paper, we look into whether could you get financial instability from banks experiencing massive profit loss? Could that per se could be a source of concern. A concrete area through which banks can present more risk to the society is by engaging in riskier lending behavior. So these two things we can measure. We're going to look into this. So we're going to look at whether bank profits gets eroded from FinTech competition, and whether banks engaging more risky lending activities subsequent to competition. We're going to look into those issues.
That's great. Yeah.
The other third database we're going to look at. So UBAR penetration and Alipay penetration will come from Ant Group. We also hand collect data on market interest rate products offered by banks themselves, from essentially announcements by banks and the announcement about the mutual fund bank collaboration by mutual funds. And we also, the fourth set of data would be city level or bank level data about features of cities, such as economic development, features of the banks. These are from Wind. I'm going to skip this graph. So in most of the analysis, I'm going to report results of a specification of the following kind. I'm going to link outcome variables at either bank level or city level with exposure to FinTech at the corresponding bank level or city level, plus some control variables. So most of the results will be of the following form. So that therefore I want to use one slide to explain them all. So outcome variables can include the change in bank demand deposits, household deposits, corporate deposits, whether bank will roll out their own market interest rate products, and bank profits, bank lending behavior, and so on. So this will be going to be the outcome variables. So here's specification for first thing we're going to do. I'm going to link first at the city level. We get the data from Ant Group. At the city level, flow of money getting to Tianhong Jijing or Yuebao. I'm going to use Tianhong Jijing and Yuebao interchangeably for this talk. They were essentially the same during our sample period. In subsequent more recent years, they have become different. I'm going to look at the change, flows into Yuebao from June 13, first month in which Yuebao was introduced, to a year later. I'm going to also look at another outcome variable is going to be change in bank deposits during the same period. At the city level, exposure to Yuebao will be defined as number of Yuebao users divided by population. correspondingly, you can also define Alipay exposures, same thing. So number of Alipay users divided by population. From city level, you can also construct corresponding bank level data. Let me see here. Yeah, so I can explain the bank level data measure in a second. Maybe I can let me explain in words. So different banks have different branch distributions spatially, right? So some bank may have lots of branches in one city. Other banks may have lots of branches in other cities. Giving cities importance to a given bank is measured by number of branches a bank has in their city divided by total number of branches nationwide for their bank. So for every bank, cities can be ranked by their relative importance to the bank. See, since different cities have different exposure to UBAR, you can convert a bank level exposure to UBAR by looking at essentially weighted average of city level exposure to UBAR, where the weights are proportional to their city's importance to their bank. Let me see one more time. We have city level exposure to UBAR. From that, we can construct bank level exposure to UBAR. What is bank level exposure to UBAR? Bank level exposure to UBAR is average of city level exposure to UBAR, where a city's weight is proportional to their city's importance to their bank. Okay, so therefore we can have city level measures and bank level measures. Okay, so when we are going to link, say the first thing we do is to link, say bank level or city level funds flow into UBAR with bank level or city level exposure to UBAR. One possible concern is endogeneity. In particular, for example, maybe some cities people already have decided to leave banks. Banks are paying terrible things. They're going to look for some way to invest in mutual fund products. UBAR happened to be one convenient tool that allowed them to do that. So it's not UBAR that caused them to want to invest in mutual fund, because they already decided to invest in UBAR, invest in mutual fund product already. UBAR happened to come coincidentally at that time, and they're going to do that. And to address the issues like this, we can use instrumental variable approach, and we're going to consider two types of instrumental variable approach. I think I'm speaking might be too slowly. I need to speed up. One is to look at Alipay penetration, which we can measure city by city or bank by bank. Alipay, just to remind ourselves, was introduced about 10 years before UBAR, so it was predetermined by a long time lag. At the time when Alipay was introduced, no one was thinking about the UBAR, including M Financial itself. I think it was not thinking about UBAR. So it is predetermined. That's a candidate that make it to be a candidate for IV. Another candidate for IV is a city's at the city level, a city's distance to N group's headquarters. Maybe another candidate for IV. The idea is that to the extent M Financial is not able to roll out, in order to roll out the either Alipay or UBAR, especially Alipay, you have to negotiate with merchants to accept your app, and this negotiation actually requires physical labor to talk to people. To the extent that N group wasn't able to talk to every single merchant in one day, you have to roll out essentially in pieces. It will be natural to assume that places that are physically close to Hangzhou or Shanghai get negotiated first, and you're going to see more Alipay / UBAR penetration places closer to N group's headquarters. Both can so this particular idea can be verified in the data. And data suggests that's indeed the case. That here's the first stage regression results. If you regress UBAR penetration on Alipay penetration city by city, you get a very strong, get a positive significant coefficient with extremely high t-stat. If you regress UBAR penetration at the city level, on the city's distance to Hangzhou, you get a big negative and significant coefficient. Neither should be very surprising to us, but this is, as the data strongly confirm that's the case. We go to the second stage of looking at how city level or bank level investment in UBAR can be linked to city level or bank level exposure to UBAR through either OIS or through any of the two instrumental variables. You get a confirmation that UBAR penetration seems to be responsible for money going to UBAR mutual fund, money market fund. The next outcome variable we look at is what happens to banks' deposits. So here I'm reporting. Let me move this. I think it's bank level data. So reporting. So for 39 banks, unfortunately, only for 39 banks, we can get from bank from Wind banks level of deposits year by year, from which we can compute what happens to bank deposits from the year before UBAR to 2 years after UBAR was introduced. We find, so on these slides, the first 4 columns correspond to change in household deposit bank by bank, and we see a strong negative association between the two. With IVs, if the IV is valid, one can assign causal interpretation. This suggests that banks with more exposure to UBAR competition tends to see a relatively bigger drop in household deposits. The next 4 columns are corporate deposits. I want to say that the features about UBAR fund we describe make it especially relevant as a substitute for demand deposits of households, not relevant for other bank products. So one can think about like the columns 5 to 8 is a type of a placebo test for deposit items not facing UBAR competition. Do we see similar kind of a change or not? The answer is no. Corporate deposits do not seem to be affected by UBAR competition, but household deposits are strongly negatively affected by UBAR competition.
So during this time, I think consumption over GDP ratio has been declining, even though we are growing pretty fine. The entire economy is growing pretty fine. But if you look at the aggregate data, the consumption over GDP ratio of China has been declining. What happens if this household deposit declination was brought about by this entire aggregate consumption over GDP ratio?
Yeah. So the idea is there can be something affects household saving investment choice, and I have separate theory trying to understand that phenomenon. But here, for our context, the maintained assumption is that those kind of features are not correlated with city level or bank level exposure to UBAR. That's the kind of assumption. You can think about the things we discussed are something that affects intercept or time fixed effect. This regression is, we will talk about changing deposits regressed on Alipay exposure is econometrically speaking is a cross section regression. Because of the change, you can also think of this as equivalent to panel regression with bank fixed effects. It's not really useful for us to do full panel regression year by year, because after 2013, the subsequent change in UBAR exposure at either city level or bank level can be endogenous to many other stuff, right? So it's not very, there's no additional useful variation one can explore that will be exogenous once we go beyond this cross section to a panel regression.
Okay, so excuse me, just now I wonder that the only first year of launch of the UBAR use is, well, I just wonder whether later it will have more competitors instead of UBAR other channels of FinTech.
It will work qualitatively the same way. So indeed, partly inspired by UBAR, many other FinTech companies, not just big tech companies like Tencent, maybe mostly other kind of FinTechs one who offer similar kind of products, but they will play the same role essentially because the key feature of the story. We said it in the paper. I should have said it verbally as well. Is that offering market determined interest rates means very different things for banks versus FinTech companies. For banks, it's a cannibalization of their existing product because low interest rate means low cost of capital, and that's good for banks. And demand deposits are important source of funding for banks. In contrast, for FinTech, they cannot attract deposits. So and therefore, offering market interest rate means very different things for them because they allow them to attract funding, but they don't have to, they don't lose anything from offering high interest rates. Therefore, FinTech companies and commercial banks have very different incentives with regard to whether we should pay market interest rate or not. Your point about the young end group, if other FinTechs also join the race and start to offer their market interest rate products, they all play qualitatively the same role in terms of putting pressure on commercial banks to do something to respond. So they can also contribute to ending financial repression. So in spirit, it's consistent with our story. We don't have direct evidence, and we don't really have data on other FinTech groups' products. The other thing I want to say, the other evidence I want to say is that we can also split household deposits into demand deposits and time deposits. Recall, since UBAR is a very close substitute for demand deposits, more than for time deposits. If our story were right, the pattern we should expect to see is that the UBAR exposure should have a very big impact on demand deposits, but not so much on time deposits. So on the next table.
I think it depends on the interest rate, I think. If, for example, the UBAR interest saving rate is even higher than term deposit, so maybe also
there might be some effect. Okay, yeah. So in any case, in this table, currently on the slide, I split the household deposits into demand deposits in the first 4 columns versus time deposits in the next 4 columns. You see much bigger and significant result on demand deposits. You don't see, so even though the coefficient on time deposits is also negative, it's consistent with what Jianye says, you still put some pressure on demand deposits, on time deposits. But it's negative, but its standard error is much larger, so it's not significant. So that pattern, the difference between effect on demand deposits and on time deposits, is also consistent with the idea that UBAR is a serious competitor for bank demand deposits. So here's another picture that shows the growth of money market funds in China. Money market funds with T+0 feature, I should say, because they were funds without T+0 feature before 2013. They were not that relevant for us. So we showed the growth of money market funds with T+0 feature quarter by quarter, around the time when UBAR was introduced. We see essentially before UBAR was introduced, there were no close to having no such products available. Afterwards, you see an explosion of those products. For each quarter, the 3-color scheme refers to money market funds linked to UBAR, that's in red, money market funds offered by other banks, that's in light blue, and money market fund product with T+0 features that offer independently through mutual fund companies' websites, for example. That's in light gray. So they essentially all happened after UBAR was introduced. And UBAR used to be, in the first few quarters at least, UBAR was the single most important component of that picture. So UBAR was essentially a single vendor that accounts for a very large share, whereas all the other color scheme is a combination of, blue will be a combination of similar products from all banks. Gray will be a combination of similar products from all mutual fund companies independently. So UBAR was a big deal. Over time, of course, eventually UBAR's share will decline. That's because enough of other people are offering similar products. But that does not change our story that UBAR plays a special role in ending financial repression. Here's another picture that shows that subsequent to June 2013, you see an explosion in number of banks distributing T+0 money market funds. That's in blue. And we see an explosion in number of T+0 money market fund products distributed by banks. That's in red. The red is above blue. That's because some banks offering multiple products with T+0 features. Crucially, before June 2013, these two lines were essentially zero. That's very important to keep in mind. Now, of course, this is just a broad picture. In the next few minutes, I'm going to use regression to try to show that there seems to be a causal relationship from UBAR introduction and explosion of T+0 money market fund products. Okay, so that exercise is going to be explore variations across banks and across regions.
I think, yes. So this very clearly solved my upfront question, right? The coexistence, but initiated by the launch of UBAR. But for example, then, so after that, you see also the difference of the two lines, and also where you attribute all the Baotai products distributed by banks, maybe some on-site products. Can you call them all FinTech? Maybe not. Or, right. So if
they are. So banks. So our story is going to be bank defend themselves against the UBAR competition by investing their own technology, including their own type of a FinTech. But FinTech broadly defined. For example, many of the products. So bank upgraded their mobile phone application. Bank put a lot more products online. So today, even bank customers wanting to buy mutual fund products, they tend to buy online rather than going to a bank branches. So certainly bank has invested in more in technology and offer more technology-enabled investment opportunities.
Yes. So actually, my question is that, so I wonder, for example, just to make clear, so here, the blue line is that the Baotai products only sold by banks through their own technology online channel, not for all the on-site.
All channels. So there's no. Typically, when there's no distinction between the two. So bank tend to, if they offer something online, they also offer the same thing offline, vice versa.
Yes. So then my worry is that, for example,
my main point is that banks didn't do this before June 2013.
Sure. This is this is our agree on this point. My question is that, for example, after June 2013, for example, where you attribute all the magnitude of explained by the launch of FinTech, or for example, some response by banks to their on-site sale, for example, to attract some people, maybe senior people who do not use online channels, but they still, because this response of banks give more diverse and beneficial products, they go to banks, buy. And whether you attribute all these things to FinTech, or you try to also separate them and to see what's the sole only effect of the UBAR's type FinTech, or another by the response. I just wonder whether you.
So on the next slide, I'm going to use variation across banks in terms of exposure to UBAR to see the role Yuebao plays in banks rolling out their own T+0 money market products. So I'm going to explore cross-bank variation and going to see, whether the observed behavior of bank rolling out T+0 product can be linked to the exposure to Yuebao. So on this regression, on this slide, I show first essentially linear regressions of so the zero. So left hand side will be 0, 1 coefficient, 0, 1 variable, dummy variable, that looks at whether in the first few, I think like a 2-year period, whether a given bank will roll out the T+0 product or not, regressed on that bank's exposure to Yuebao, controlling for some other bank features, including size, number of branch shares, deposit features, and the average income level of the cities in which the bank has a presence. And we see that the coefficient in blue means that banks with greater exposure to Yuebao are more likely to roll out T+0 money market fund products in the first few quarters of a Yuebao launch. The IV regression confirms this, and to the extent IV is valid, we'll say that there might be a causal relationship from Yuebao exposure to bank launching their own product. On the next slide, on this slide, I switched to a hazard model. Just look at the essentially the left-hand side. The interpretation will be whether the probability in any given period, the likelihood that a bank will roll out the T+0 money market fund product can be traced to banks' exposure to Yuebao competition. The answer seems to be yes. Either straightforward without IV or with IV regression that confirms that seems to be the case. So in other words, this puts the interpretation on this graph that this graph reports picture for all banks, summing up all banks. Now I'm saying the regression slides tells us that if you explore cross-bank heterogeneity, you find a role of exposure to Yuebao. So the picture is not just coincidence, right? So one can make an argument that there's a causal effect coming from exposure to Yuebao and rolling out the bank's own product. I'm going to skip this slide. So the last thing I want to say, linked to early discussion about consequence of fintech competition. Can there be negative consequence of Yuebao?
Professor Wei, sorry, can you before
Please.
you go to the summary, I was wondering.
Not summary yet. I have one more thing to say before summary.
Oh yeah.
So, yeah, but go ahead.
Yeah. But just for this part, I think the time period you consider here is associated with the rise of the shadow banking sector in China, like from 2012 to 2017. I was wondering if we consider, obviously shadow banking crowd out some part of the either demand deposit and the term deposit. So I was wondering how to rule out the influence from the rise of shadow banking.
Okay, I will answer that question just in a second. Let me first summarize. What we have seen so far is that households' investment into a money market product can be traced to the spread of a Yuebao. Number one, we see through IV regression by exploring variation across cities, across banks. That seems to be the case. And our story is that this puts pressure on banks, because banks may be losing deposits if they do not do anything. So they have to do something. What do? They invest in technology. They roll out their own products that pay market interest rates. Because they did do that, effectively the era of financial repression is over. Even though the ceiling on demand deposits is officially removed in 2015. But the competition from Yuebao in 2013 and banks responding to that pressure and offering increasingly more market interest rate products themselves make it less important for a bank to defend the previous ceiling on demand deposits that paved the road for ending financial repression. Right? So I just want to summarize that first. Now come to Yingju's question. people often describe banks offering wealth management products as part of the shadow banking activities. So in a way, we are actually documenting this. So some of the rise of shadow banking activities can be interpreted as a response to fintech competition. Now, the question we want to know is whether that type of shadow banking activities increases banking sector instability or not. That's what I want to know. Now, we cannot answer the question conclusively. So in our context, we're going to look at two narrow pieces of the question. One is, what happens to bank profits? Is it the case that those banks more exposed to UBAR competition experience a relative decline in profit or not? That's something we can examine. That's number one. Number two, we're also going to examine lending behavior. In particular, we're going to look at the default rates, whether banks with more exposure to UBAR competition experience relatively greater default rates in our period, whether a bank lending portfolio can be also classified by level of risk. We're going to see whether relatively risky type of lending rises as a share of a total lending portfolio for those banks with which are most exposed to UBAR competition. So these two questions we can examine. These are pieces of the broader question about whether shadow banking activities triggered by fintech competition leads to more risk for the society as a whole. Okay, so that's the last thing I'm going to do. So I'm going to see. So I want to see first qualitatively. We can think about story go in either way. If banks, suppose banks had no rents to start with, banks were already earning comparative returns, then most likely fintech competition will cause dropping profits and more instability, because any additional investment, they were already earning very low comparative returns. Any additional investment potentially will drive down returns. On the other hand, if banks were earning sizable rents before fintech competition, which seems to be likely because it's a very concentrated sector, interest rate regulation, in fact, is a way to protect the banks. There's very severe entry barriers. Not anyone can open a bank. Most people wanted to open a bank cannot open a bank. That we also know. The existence of rents pre-UBAR suggests the possibility that perhaps part of the response by banks is to work harder, find efficiency gains, and they can use those efficiency gains to do the investment in technology. They have to offer market interest rates, but potentially through their effort, they will, we might not necessarily see an increase in banking sector instability. But in any case, we use bank level data from banks' disclosure in WIND and see, what happens to various financial variables. And we see no correlation between bank level exposure to UBAR and bank level change in net interest margins from the year before UBAR to 2 years after UBAR. This is true whether you do IV or not. We also see we also do a regression on profits and risky activities. Here. Yes, please.
Okay, so here we are consider the on-balance sheet stuff. So have you considered about the off-balance sheet activities? Mm-hmm. Because when the banks when the banks offer those wealth management products, because lots of products have some kind of implicit guarantees, and they are off-balance sheet, and typically for those things they like have contain higher risk. So
our approach is to gather as much information as we can and examine whether they have any relationship with exposure to UBAR. So it's possible some of the off-balance sheet behavior, such as whether bank offer a guarantee or not, is something that we don't really observe in the database. So I'm not ruling out the possibility that there can be some increased risk, whether or not they are related to UBAR competition, but we cannot measure this. So I'm reporting the things we can measure. So one is we report whether there's any change in bad loan ratio. We might imagine some of the if there's an increased risk in shadow banking activity, some of them will be reflected in unbalanced sheet variables eventually. We're going to look at here I'm reporting two of them. The one is exposed bad loan ratio, and that variable does not seem to be correlated with bank level exposure to UBAR. It's true.
Well, how about the market
IPs.
value of banks? Because the investors will know the risk, so it will reflect in like the PB ratio or something like that.
So back in 2012, relatively few banks are listed companies. So that exercise is actually difficult to do. Even today, most banks are not publicly listed, but many banks, some of the publicly listed banks were listed in the last few years after 2012. So it's a good exercise to do. We thought about it, but it's hard to implement. Columns 5 to 8 look at the change in risky asset ratio. So that ratio potentially can reflect some of the shadow banking activities. So there are paradoxically we see in some specifications a decline in risky asset share of total assets linked to UBAR exposure. We don't really have a good explanation for why there's a decline. But we don't see a positive association. But if any of you have an explanation for why we see a decline in risky asset ratio, I'll be very happy to hear that. I didn't report the profit, but we also look at the bank level profits. So even for because financial firms are subject to more regulations, even for non-listed banks, they have to disclose financial variables. And bank level profits also seems to be uncorrelated with bank exposure to UBAR competition. So our interpretation, given these results, our interpretation we want to be cautious in interpreting this. So the way we say this is, at least the data does not reveal any evidence supporting the idea that the fintech competition leads to a decline in profits, leads to an increase in risky activities. We don't rule out things happening in for variables that we cannot observe and measure. Our interpretation, if it is the case that fintech competition simply cause banks to work harder to find ways to improve efficiency, that can come from the fact that before UBAR, banks had a lot of rents. So UBAR essentially eroded the rents, inspired them to work harder. And apparently the effort can to a significant extent offset those potential increasing cost of capital coming from UBAR competition.
So you also notice that most of the banks in China, or the largest banks in China, state-owned banks. So for those tycoons, I mean the state-owned banks, they deal with bad loans in a very different way than most of the commercial banks, privately owned commercial banks. So if they have bad loans, then someone else is going to pay for that, like Department of Treasury, right? So that really means fintech affects their balance sheet because of their nature, the state-owned enterprises or state-owned banks.
So I interpret that state-owned banks, especially large state-owned banks, is right. The reason for why they enjoy so much rent before liberalization. So part of the the reason state-owned banks executives are politically powerful, can influence regulators, and can maintain regulations beneficial to the banks, is because they are state-owned. In terms of so I was trying to understand your question. So one version of your question could be whether let's say the non-performing loan numbers are meaningful or not. So there, I guess I would appeal to what the Chinese banking regulator says. So they think they adopt international standards. They will force banks to. So the banks may not have to, bear all the consequences of a bad loans, but they have to disclose.
Yeah, this is what I exactly mean.
And Chinese banking regulators think that the Chinese banks' disclosure is of reasonable quality. That they've done a lot better, far better job now than they used to in terms of disclosure. So to the extent disclosure is reasonable quality, what we were saying is that there's still changes in bank non-performing loan ratio, but the non-performing loan ratio at the bank level does not seem to be systematically linked to bank level exposure to UBAR. That's what we want to say. I can skip the summary slide. The main thing I guess I'm saying is that we think the data support the idea that FinTech, especially led by UBAR, play a significant role in causing banks to respond to this, thus ending the period of financial repression. Number one, and number two, that available evidence does not support the idea that banks' asset becomes riskier as a result of FinTech competition. I welcome any additional criticisms, comments, suggestions for future work.
Yeah, thanks, Professor Wei. It's very interesting, and I think we have still have about 30 minutes to discuss. Is there anyone want to raise some questions?
Can I have some further thoughts, Shang-jin? So I'm thinking about whether this liberalization can benefit small companies. So maybe before the liberalization with the ceilings, the interest rate ceiling, so mainly to kind of the bigger companies get a sort of the major benefit of the subsidy. So I know the banks get the kind of the benefit of the ceiling, and then but probably only the bigger companies can get loans from these bigger banks. So sort of the benefit transferred to small to bigger companies, the real companies. So after this liberalization,
your conjecture is very likely to be right. Yeah. So a possible follow-up paper would be this: the financial liberalization also causes redistribution, realignment of interest between smaller banks and larger banks. Maybe that's what you are driving at, right? The smaller banks.
Yeah.
So the interest rate regulation benefited large banks more than smaller banks because smaller banks have harder time to attract deposits. Interest rate regulation means they cannot use comparative interest rate to attract funding. So interest rate liberalization can benefit smaller banks more than larger banks. That's number one. And number two, to the extent that smaller banks serve smaller firms or small medium-sized firms more than large banks, on the borrowing side, private sector firms, small firms are likely to benefit more from interest rate liberalization through that channel than large banks. I think it's very likely. Yeah, I mean, there's a high likelihood that this is true. Yeah,
thank you.
So,
thanks.
so
I hope
a
can have data to verify that. Yeah, thanks. Great talk. Learned a lot. It's very informative. Thanks.
Thank you very much.
Hi, Professor Wei. Thank you for your presentation. Just a follow-up thought that after 2017, there's a more tight regulation for UBAR, and eventually there's a cap, de facto cap. It's about between 1 and 2 trillions. If we think the launch or the introduction of UBAR provide as a financial liberator to make the sector more competitive, is that possible that eventually with the cap, then this competitive force become less and less important and less influential? Is there a possible way to kind of measure or identify this effect? Just
so yeah, good comment. So I want to say two things. One is, banks didn't really like fintech competition in that particular area, and there's evidence of that, right? So right after UBAR becoming popular, bank executives wanted to kill. There was some attempt to kill UBAR, but didn't succeed initially. For example, in the March 2014 Lianghui, the Congress and the Political Consultative Congress of China, some of the Lianghui representatives were large state-owned banks executives. They were vice ministerial level officials. One of the proposals from them was to essentially kill UBAR. Kill UBAR was not that particular phrasing, but essentially it meant that didn't quite work. So the liberalization also benefited from China having a relatively relaxed or market-oriented central bank governor of the time. The central bank governor of the time wanted to. So another way to say the story is that people in the government do not have the same view. You can't have a central bank governor. Individual officials like the central bank governor would be happy to push for interest rate liberalization, but he couldn't make that to be a policy because there were so many people opposing to that idea. So he couldn't make it work on his own. The emergence of a fintech creates a bottom-up liberalization that the central bank governor happened to personally like or sympathetic with. Right? So it make it much easier for him not to kill fintech than to impose interest rate liberalization on commercial banks. If I were a political scientist rather than economist, political scientist book would talk about individual details. They pay attention to personalities and so on. So in a way, maybe the personality of the central bank governor of the time also plays some role. So even though many banks wanted to see an end of the fintech competition, the eventual cap on the growth of UBAR can be interpreted as just as a force. There were always forces in the society that don't like that kind of a competition, and the cap on UBAR is something that is beneficial to banks. Well, we can argue. So that certainly is a possible interpretation. Then what this means is that financial liberalization is never automatic. That's why even in digital age, we do not see financial liberalization in every single country, because you can always have powerful groups opposing those liberalization. In some countries, this group can win. But fintech, compared to a time without fintech, make liberalization more likely than otherwise the case. I guess that would be my interpretation.
Professor Wei, can I ask one question regarding the margin, how the fintech firm are going to affect the traditional banks? So, so there are two margins, I would imagine. So there's a kind of intensive margin and extensive margin. So on the extensive margin, you can think that the fintech penetration is going to reallocate for a given customer, kind of reallocate your kind of demand deposit to the fintech money market fund product. But there is also a kind of extensive margin in the sense that intensive margin in the sense that for the new customers, a fintech firm may have a kind of great advantage in attracting new customer. I'm wondering how your kind of effect are kind of are driven by these two kind of margins.
Yeah, so we actually for the next iteration, we are asking for additional data to separate the exposure to UBAR into growth in the number of accounts versus change in the per account value. So with that, we'll be able to answer your question. So right now, I do not know yet. So we are combining the two.
Okay.
I'm also happy to talk about my book if anyone wants to have a question on that.
Any more questions for Professor Wei?
Okay, I have another like small question. So I remember some people say because the reason they want to put a cap on UBAR is argue that there might be some liquidity risks, right? Because basically banks are issuing those money market funds. So this kind of money market funds is so big, and there might be some liquidity risk. No.
UBAR was very big. UBAR / Tianhong Jijing at one point was the world's largest money market fund. Maybe today it still is. It still be one of the very largest money market funds.
But the money
it is possible to be concerned.
The money fund ultimately go to banks, right? At least half of those money invested in products of banks.
Yes, so indeed the asset you talk about on the asset side of the money market funds, they buy short-term securities, including those issued by banks. Indeed.
So if the consumer, if the retail investors they wanted to like withdraw those money, like the UBAR, so there will be some liquidity risk. Right.
If yes, so redemption of a money market fund products will cause money market funds to sell those products, which could if everyone does it at the same time, it is a funding shock to banks. What you're saying, that certainly it is a possibility.
Thank you.
Yeah, I saw Weige raise his hand.
Please.
Thank you for your wonderful talk, Professor Wei. Yeah, I actually have a questions about the liquidity risk, something like that. So because like a few months ago, something happens to Alibaba CEO, and then I worry about if something happens to Alibaba, what will happen to the UBAR? And then if something like the people might afraid about that. Okay, if all the people who use the UBAR and just withdraws their money, what will happen to the fund?
So in a narrow sense, there's nothing to if Ant Financial disappears, the investment in UBAR is completely in as long as Ant Financial does not commit the accounting fraud, the money goes into UBAR is not used for lending. So the money, Ant Financial's lending lending is funded by a separate source of money. Does not come from Tianhong Jijing. So money put into UBAR goes entirely into mutual fund products.
Yeah, actually this is my concept. So suppose all the people who use the UBAR just withdraws their money, and then I think the interest rates for the mutual fund will go. The price will go down a lot, and the interest rate will raise up. So, and at that time, I think. Do you think
why would the price go down?
Because all the suppose I want to redeem the money. And then all the people want to redeem the money in a day, and then what will happen? And then
you talk about workout. You can imagine that some agency can be just speculating. And financial is in very strong financial health as far as I can tell. But if it were to happen, if there's a need for to wind down the UBAR operation, some other agency can take over. You can manage very seamless transition because the liabilities of UBAR are people's investments. The assets are in actual mutual fund products. So they are not they are not used for Ant Financial lending. So my understanding is there's no unless something wrong with the mutual fund market, it's not which is not directly linked to Ant Group itself.
Okay, thank you.
You can think about this like essentially like accounting. There must be a technical term. It's a separate account essentially. Like the UBAR is like a gigantic account. Money going into UBAR goes into mutual fund products. So they are not commingled with other financial operations of the Ant Group. Now, of course, not everyone understands this. right? So if there's a need to to manage this, someone has regulator have to move very fast to just explain that very well. So some other agency can take over, can manage this, right? So, but in principle, at least, as long as UBAR investment actually goes to mutual fund products, which I understand that's the case. So disappearance of N group itself will not cause problem for UBAR investment.
Yeah. Right. Thank you. Thank you.
Yunyi, please.
Hi, Professor Wei. Thank you so much for the insightful sharing. And I think in this paper, you narrowed down the scope of FinTech to UBAR. But sometimes when we talk about FinTech, we usually think about other things like blockchain or like cloud or some other stuff. And do you think these other types of FinTech could have similar effects on the financial, can act as a financial liberator and can stimulate the financial innovation among banks? And do you think it could be a feasible topic to investigate? Thank you.
It certainly is a feasible topic to investigate. I don't want to make a very general statement without having data. So in principles, certainly some of the other FinTech products can play the same role in terms of increasing competition, leading to better rates for customers, better service, and so on. But it means one does not want to generalize too much. There certainly can also be just like financial innovation in general, right? There can certainly be type of financial innovation that can create negative externalities for the society as well. Each of them, I think, deserve a good study.
Thank you, Professor.
Any more questions for Professor Wei?
Well, thank you very much.
Yeah, and then maybe we still have a few minutes left. Maybe you can introduce your new book to us.
I don't have, for those of you who don't want to hear about new book, you are liberated. So I want to liberate the audience first. This is, so in the background is a book, 寻找经济最优解, released 10 days ago. It's a sort of a non-technical book. A collection of my thoughts on financial development, FinTech, globalization, and trade-off, and efficiency and social justice. Those topics. I'm happy to report that has climbed to 当当网经济类热销书#1. 当当网经济类热销书#1. But if with additional friends help, hopefully we'll stay there for a few more weeks.
Great. Yeah, then I guess we can conclude here. So thanks again, Professor Wei. It's a really interesting talk, and we learned a lot. We hope to see you soon in our future kind of webinars or other activity at the Academy. Thanks.
Thank you. Thanks to everyone. So.
Bye, everyone. Have a good night.